Are you wondering if you've saved up too much or thinking about your insurance? This week, we have two very interesting webinars just for you. At 10 a.m., we have How Much Savings is Too Much Saving. That will also discuss how best to utilize your savings. And at 12, we have a webinar on what's really happening in the life insurance sector. This will be hosted by our very own research analyst, Sanjay. Click the link below to register, and we hope to see you all there.
The three things to avoid now. First, avoid buying shares in pre-IPO trades. Clearly, today, pre-IPO selling of shares is seen as a more profitable way to exit for selling shareholders because the premiums seem to run ahead of even what an IPO can give as a price discovery. In several companies which have listed in the last 1 year, the pre-IPO prices have been higher than the IPO prices and definitely higher than the listing prices as well. Yet, people still are clamoring to invest in companies prior to IPOs. This whole interest comes from a historic trend where companies IPO'd at lower prices and the listing day pop was so high. So people think that buying before the IPO may give them these stocks at prices lower than the IPO price itself, leading to a double spread in profits. Instead, we are seeing a negative spread coming in the investors' books. I think that the sellers are too smart. The intermediaries are too aggressive. The FOMO factor, the fear of missing out on owning these shares is very, very high. Too much money is chasing stocks in these opportunities. As a result, these companies are getting bought at unrealistic valuations in the hope that the IPO will happen at a further unrealistic valuation and a secondary hope that the listing will be even more unrealistic. Generally, assuming that others will be unrealistic to give us our profits is not a realistic expectation. We should always be prepared for a market where sentiment does not support valuation, where we have a margin of safety even if sentiment turns adverse, and we would not see a drop in our valuation at the time of an IPO and immediately after. The whole idea of investing before an IPO should be supported by the valuation. If the valuation is not right, blindly going and buying before an IPO in the hope that you will always find a greater fool after the IPO is avoidable. I think that's not the right way to do it. I think if you do it, you're going to set yourself up for pain. We've seen several companies in which these trades happened. If you look at the last 20 IPOs, many of them have pre-IPO shareholders who are struggling to get the price they paid. In some, the wait has been very, very long. In others, the wait still is open-ended. Nobody knows how long you have to wait. The whole purpose of investing in a company should be to have liquidity. Most pre-IPO investors don't have enough liquidity because you get locked in for some time, and by the time your lock-in opens, a whole lot of people are waiting to sell, including those who got in through the IPO. So pre-IPO is something that you should definitely avoid participating in right now. The second thing to avoid right now is putting all your money into an IPO. Many people think that because ASBA is there and money is idle in a bank account, they can always gamble in an IPO. Putting all the money they have, within 7 days the money is coming back. Whatever money gets allotted, those shares can be sold on listing day for a profit. While this has worked in quite a few companies, I don't think this is a correct approach because in some IPOs, if by mistake you get allotted shares for all the money that you put in, then you're in trouble. your liquidity goes out, and later if the market falls, you cannot sell these shares so easily, nor can you buy other shares which you would otherwise have bought based on your investment preferences. So this gambling takes away precious capital which you have kept aside for some other purpose. It could be to invest, it could be for your business, it could be for a marriage, it could be for your retirement. Don't put such monies in IPO speculation simply because the money is idle. Avoid putting all the money you have in ASBA and gambling in IPOs. That is the second point that you need to avoid. The third point is don't buy on listing day. That's absolutely the wrong day to buy a stock. Don't simply buy on listing day hoping that you will sell it 2 days later. That's not the way investment should happen. And this is not a market where such trades are supported by sentiment. There is enough supply of stock through IPOs. You're going to have more than 1.5 lakh crores worth of IPOs happening in the rest of this financial year. So there's going to be a flood of IPOs. And if so much money is going to be raised in our stock market, then listing day speculation is something that you need to avoid because it could be very risky. If you get stuck in some stock, then getting out later would be painful. You need to wait. You may make short-term losses. All these things clearly are avoidable because the odds are not in your favor. If a company does list at a significantly higher valuation on listing day, it means that the difference in valuation between what should have been the IPO and was the IPO price is already discovered. So expecting more profits by buying on the day is a risk not worth taking. Take your time to study the company, give time for a price discovery to happen in the market, and later you can buy it even if the price is higher because you would know clearly what is the fair value of a company. On listing day, the chances of your knowing the intrinsic value of a company is low because you don't have enough data and results to crunch and arrive at a fair valuation. So these are the 3 things that you should avoid right now. Avoid pre-IPOs. Avoid putting all your money into IPOs like a lottery. And third point, avoid buying on listing day. If you avoid these 3 things, your life will be simpler and you would be able to do some simple, sensible investing because I think that's what will work in a period like this. Thank you for watching this video.